For stock market investors, the past decade has been phenomenal. Since its 2009 bottom, the S&P 500 index has increased 7-fold, and the Nasdaq has increased 16-fold. Every pullback was temporary, and the markets quickly recovered and set new all-time highs. No wonder then that investors have grown complacent. They've learned that no matter what happens, they should always buy the dip. Many of them assume that the bull market will continue indefinitely. But is that truly the case? Is it possible that the stock market has already topped in late 2021? Are we headed towards an epic collapse? The 2008 financial crisis ushered in the era of central bank intervention. What began as emergency measures, meant to rescue the economy after the bursting of the housing bubble, has turned into a permanent policy. The Federal Reserve slashed its interest rate to 0 and kept it there for 7 straight years. In addition, it had embarked on a series of bond purchasing programs, also known as quantitative easing. The assumption was that by suppressing long-term interest rates, it could stimulate the economy and generate growth. But in hindsight, this is not what has happened. In spite of these interventions, real GDP growth in the United States remained pretty low, and since the financial crisis, averaged only 2.25% per year. This is the official figure. The true figure is probably worse, because inflation is always understated. The stock market, however, absolutely loved these interventions. Since the launch of quantitative easing, the S&P 500 index has risen by a whopping 600%. During this period, the stock market has become completely detached from the real economy. Bad news for Main Street was considered as good news for Wall Street, because it ensured that the flow of easy money would continue uninterrupted. FOMC meetings and subsequent press conferences became major market-moving events, which the entire financial world would focus on. To this day, many economists deny the connection between QE and the rally in the stock market. But the correlation between the two is striking. Whenever the Federal Reserve printed dollars in order to purchase bonds, the S&P 500 would rally. And whenever it stopped the printing, or God forbid tried to unwind its balance sheet, the index would enter a correction. The only caveat to that was the period between 2016 and 2018, when Donald Trump's tax cuts and fiscal stimulus allowed the Fed to take its foot off the gas for a while. I argue that the Fed's actions had little to do with the recovery of the real economy. But on the other hand, they led to the formation of the greatest stock market bubble in human history. I also believe that this bubble has already popped, but the public is still unaware of that. In a few moments, I will show you what led me to this conclusion. But first we need to explain what exactly is QE. QE is the process in which the central bank increases the monetary base by purchasing securities. For those of you who don't know, the Federal Reserve has the unique authority to lend money into existence. Whenever it buys a government bond, new dollars emerge out of thin air. It doesn't purchase these bonds directly from the US Treasury. Instead, it buys them from its member banks. In return for the bonds, the banks receive bank reserves, which are deposited in their accounts at the Federal Reserve. In the past, banks were required to keep a certain amount of reserves as collateral for the loans that they issued to their clients. But this requirement was cancelled in March of 2020, and nowadays banks are not required to hold any reserves whatsoever. We should point out that banks can't do anything with those reserves. They can't spend them or invest them in the stock market. The only benefit that the banks get out of holding those reserves is that they earn interest on them. And that is a risk-free income that they receive from the Federal Reserve as a reward for helping it conduct its monetary policy. If the banks couldn't spend or invest the dollars that they received from the Federal Reserve in exchange for the bonds, how could they possibly affect the stock market, you may ask? Indeed, those newly printed dollars never reached the markets, but they could still affect them indirectly. As I've explained in my previous video about the bond market, which you are invited to watch, there is an inverse correlation between the price of a bond and its yield. The higher the price, the lower the yield, and vice versa. What QE programs have done was to generate an artificial demand for government bonds, which suppressed their yields. How does that matter? Well, since government bonds are considered as the safest asset you can own, their yield is always lower than that of corporate bonds. By suppressing government bond yields, the Federal Reserve made corporate bonds more attractive and allowed their yields to fall as well. To make a long story short, the true purpose of the QE programs was to allow corporations to borrow more cheaply from the public. This way they could develop new products, hire more workers, and generate growth. This at least was the theory. But in practice, they didn't do that. What corporations chose to do with the bulk of that money was to buy back their own shares. A share buyback is when a company uses its money to reduce the amount of shares outstanding. By doing so, it is able to artificially boost the price of its stock and reward the shareholders. It is also able to increase its earnings per share and pretend as though it is more profitable. Isn't that market manipulation, you may wonder? Shouldn't that be illegal? Well, it is definitely a form of market manipulation, but it is perfectly legal. And most large corporations nowadays are doing it regularly. Since the 2008 financial crisis, S&P 500 companies have purchased their own shares to the tune of $8 trillion. Their managers were incentivized to do so because they were compensated based on the performance of the stock, rather than the long-term viability of the company. In my view, a company is entitled to use its profits in any legal way it sees fit. However, when a company takes on debt in order to buy back its own shares, that is downright dangerous. In the long term, this debt could become a burden on the company and lead to its downfall. According to my estimate, since the 2008 financial crisis, about a quarter of the share buyback schemes were financed by issuing corporate bonds. This amounts to roughly $2 trillion, which thanks to quantitative easing found their way to the stock market. There is reason to believe that this was the main driving force behind the spectacular rally we have witnessed in recent years, and that it was all predicated upon the cheap money which was printed by the Federal Reserve. Since more than half of the stock market is owned by the top 1% of earners, this amounted to a huge wealth transfer to the rich. No wonder then that during this time period, income inequality in the US has increased dramatically. To get an idea of how big the bubble in the stock market has become, we can look at the price-to-earnings ratio of the companies which are leading the S&P 500 index. The price-to-earnings ratio is a simple and effective indicator of how expensive a stock price is. It shows you how many years the company needs to maintain its current earnings in order to justify its price. Historically, a company is considered to be cheap when it is traded at a P/E ratio of less than 10. At a P/E ratio of between 10 and 20, a company is considered as fairly valued. Anything above 20 is expensive, and if a stock is traded at a P/E ratio of 30 or more, then it's in bubble territory. Now let's have a look at the current P/E ratio of the large tech companies which have led this rally. Apple, 29. Microsoft, 34. Google, 29. Amazon, 102. Nvidia, 101. Facebook, 36. And finally Tesla, 70. According to this simple measure, all of these companies are extremely overpriced. Wall Street analysts would argue that the P/E ratio doesn't matter anymore because these companies have a tremendous growth potential, and in the coming years their profits will rise and catch up to their price. But in my view, this is complete fantasy. If I am correct, and those share prices are based solely on the ability of these companies to borrow money cheaply, then the stock market is in trouble. We should point out that the combined market cap of these 7 companies exceeds $12 trillion, and they make up more than a quarter of the entire S&P 500 index. If they go down, the entire stock market goes down with them. Now that inflation has finally broken out, central banks across the world have no choice but to stop their QE programs and allow interest rates to rise back to normal levels. The Federal Reserve has been leading this trend and since 2022 has raised its interest rate aggressively. As a matter of fact, it is currently doing the opposite of QE. It is gradually selling some of the bonds which it bought during the past decade and reducing its balance sheet. As a result, long-term bond yields are rising and the cost of borrowing is increasing. I suspect that this is not a temporary phenomenon, that inflation is here to stay, and that bond yields will continue to rise as far as the eye can see. This means that corporations will no longer be able to borrow money in order to buy back their own shares, because the cost of this dubious practice will become too expensive. Instead of buying back their own shares, these companies may be forced to issue more shares in order to raise money and pay down their debt. This could lead to a protracted bear market in stocks, the likes of which we haven't seen since the 1970s. For those of you who don't know, between 1968 and 1978, the S&P 500 index has essentially gone nowhere. Since inflation at the time was running hot, in real terms, stock market investors were decimated. Unsurprisingly, the global economy nowadays is suffering from the same conditions that we've seen during the 1970s, such as rising energy costs, political turmoil, and a loss of confidence in the dollar. Back then, this has led to what we call stagflation, which is the deadly combination of stagnation and inflation. I suspect that this is exactly what we'll have in the coming decade. Technically speaking, the stock market has stopped at the beginning of 2022, when the Federal Reserve started hiking rates. Since then, the S&P 500 index has experienced a 25% drawdown. During 2023, it has recovered, based on the hopes that inflation has been defeated. and the Federal Reserve will soon be able to resume its easy money policy. But thus far, the index has failed to set a new all-time high, and therefore the present rally could turn out to be nothing more than a bull trap, which is a classic hallmark of speculative bubbles, and often appears right after the bubble has popped. If that is truly the case, we could be headed towards an epic collapse, which will wipe out the fortunes of many investors. Hello, my name is Oren Elbaz, and I am the Silver Hermit. Since 2013, I've been publishing articles about the state of the global economy in simple and straightforward language that everyone can understand. For years, I've been arguing that central bank policy of low interest rates and QE is irresponsible and dangerous. Time and time again, I've warned that it will lead to inflation. Now, this warning has turned into reality. We're suffering from a continuing economic crisis and from painful inflation. But despite a difficult situation, we must not sink into despair. I believe there are ways to deal with this crisis and perhaps even benefit from it. The best thing we can do is to invest in our financial education. The saying knowledge is power is especially true in this day and age. So please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, these are dangerous times, but together we will reach a safe harbor. Before we say goodbye, a few words of warning. I am not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.